Looks like we are at time, so I'm going to go ahead and get started with the webinar today. My name is Chinda Chun, and I'm with NACB and the Consultants Training Institute. Before we get started with today's Around the Valuation World webcast, I'm going to go over a few housekeeping items. During the webcast today, there will be poll questions throughout our webinar. You'll need to respond to those poll questions for CPE credits if you are a subscriber. If you have any questions during today's webinar, please use the Q&A option if you have questions for the presenter. If you have any technical questions for me, please feel free to use the chat feature, as those will be directed to me. And this is our team of correspondents and editors for the show. And with that, I'm going to turn the time over to Mel and Alina, who will get us started.
Thank you, Shanda, and hello, everyone. Welcome to Around the Valuation World, October 2022 edition. Today, we have a little bit of a change in our order, the one that you're used to if you usually join us on our monthly shows. And we are going to start with the judges. Alan Zipp is going to be interviewing them. Then we will have Michael Kaplan also with them. We'll have Melissa Gragg interviewing Carla, Nunes, and Kevin Madden. And we will have Chris Hamilton doing talking about inflation. So very interesting information. We will also have Michael Gregory doing the core body of knowledge. He's going to be, usually he's at the beginning of the show, so he's going to be with us later on. And we're going to end our show with Rowena Figueroa. She's going to be talking about building your brand. So now I'm going to leave Alan Zipp, one of our correspondents, and he's going to be interviewing our judges. Alan.
Thank you very, very much. Chanda, shall I do the slides?
Yeah, do you want to try to share your screen? There you go.
I will share my screen. Am I shared now or not?
Yeah, you just
Okay.
probably do the presentation mode now. So if you want to hit from current slide right there, yeah. And that should do it.
You realize I am a dinosaur. I have no clue what I'm doing. Is that better?
That is perfect.
Okay. Let me introduce the judges. Judge Driscoll, Judge Platt, and Judge Yates. And I believe Judge Yates will be with us shortly. In any event, we're going to go very quickly through these slides. This is my slide. I'm a CPA, an attorney. I'm also accredited in business valuation, a certified business appraiser, and a fraud examiner, and a valuation analyst. And I've been teaching for a lot of years for the AICPA, and I love it. The question today is, how much business valuation knowledge does a judge need to make an informed decision? I'm looking forward to these answers. There's some details about each of the judges. Judge Driscoll is from New York. Judge Platt is from Maryland. And Judge Yates is from Michigan. So we've got perspectives on a number of states. Let me just review the entire slide question, and then the judges can do their thing. Let me talk firstly about standard of value, where the function and purpose of an appraisal may determine the appropriate standard of value. Now, as an example, in divorce, some jurisdictions apply the fair market value standard, while others apply the fair value standard, and others apply an intrinsic value standard. So the question really here is, how does the trial judge determine the appropriate standard of value to apply in a particular matter? And then how does the trial judge know the difference in the standards of value? Anybody go ahead.
Sure,
First.
I'm happy to start the discussion. As all of you have seen me perform before and teach before, you know I'm not shy, nor is Judge Platt shy, nor is Judge Yates shy when he joins. You know, he's just joining us now. That's wonderful. So let me just start with a couple of points about judges, whether they are trial judges like Judge Platt was and now is a trial judge in private mediation and arbitration, as I am now, and as Judge Yates was before he ascended to the appellate bench about a year ago or so. And that is that we are generalists as judges. We're like bathtubs. We fill up and then we empty out. Meaning that when you're trying a case in front of us, and your retained counsel is trying a case in front of us, I don't think you should assume that the judge knows anything about business valuation principles, even if you've tried a business valuation case with that judge. Because again, we do a lot of cases. We have hundreds of cases on our docket at one time, and we're filling up with the information and then we're emptying out with the information. So the judge certainly wants to be guided by you and wants to be guided by your retaining attorney in what the relevant principles are, but don't go in assuming that the judge, again, even if the judge is totally familiar, and you know the judge is totally familiar with the specifics of your business or the specifics of the principles, I wouldn't go in assuming anything. As Felix said to Oscar in the courtroom in The Odd Couple, when you assume, you make, of course, a fool out of you and me. I'll use the PG version. All right? All right. So that's my answer to the starting point, Alan.
If I could comment, and I think Judge Yates, in his capacity as an appellate court judge, can be very helpful to expert witnesses who are listening to us to answer this question, because an appellate court judge is looking at a record, and the record, if the judge does know anything before he or she goes on the bench, the record may not reflect that, probably doesn't reflect that. The question is, quote, how does the trial judge determine the appropriate standard of value to apply in a particular matter? And how does the trial judge know the difference? And the answer, as Judge Driscoll just said wisely, and as he or she doesn't until somebody tells them. And when that happens, if the record doesn't reflect that, and the judge comes out with a decision that says, for instance, that I've made the determination that the fair value standard as opposed to the intrinsic value standard, and there's no explanation as to why, at best you will have an argument before an appellate court on the issue of whether or not there was any basis in the record to form that opinion in that way. As Judge Driscoll just said, don't assume anything, because assumptions can fall very quickly, and your performance will be graded accordingly.
So the burden then is on the testifying expert to educate the court as to the standard, correct?
Correct. And if if he doesn't, and the record doesn't reflect that, they could have been the smartest judge in the world and the world's foremost expert, him or herself. And if the record doesn't reflect that on some basis, it's at best going to be an appellate issue, and at worst a reversal.
Thank you, Judge. Let me move on, because we've only got 3 hours to cover these slides, and I want to make sure we have all of it. In any event, let's move to the next question, and that's, how does then the court ensure that the expert witness applied the appropriate standard of value in developing the opinion of value? And if the required standard, for example, is fair value, such as in a shareholder dispute matter, and the expert witness applied the fair market value standard, really what then does the court do? How does the trial judge document in the record the difference between fair value and fair market value? And this is from real life testimony that I've been involved in. So
you asked the question of trial judges, and I know we really do want to hear from Judge Yates, but I think I'll take a little privilege on that, because I'm supposed the active trial judge here who's engaged in this all the time. Remember that scene in the first Star Wars movie where Obi-Wan Kenobi shuts down the tractor beam? Boom! That's what it's like when you're using the wrong standard. You're losing us. You're losing us. So if fair value is the standard and you're talking about fair market value, you might lose us along the way. So we'll probably get back there, but we want to apply the right standard. I always say that I only want to try a case once. Second time is no fun to try a case. So if I'm applying the wrong standard and I'm going in making rulings based on the wrong standard, Judge Yates and his colleagues are sending that case back saying, Driscoll, what are you doing? You didn't give him a fair shot. So I think you both run the risk of losing credibility with the judge, and also taking the risk that you're going to try the case twice, having not been effective the first time, if you were coalescing around the wrong standard. And then when it does come back, you've lost credibility with the court because you were misleading the judge on what the correct standard is. So there were a lot of risks along the way about not being aware of the correct standard for valuation.
Judge Platt, do you want to add to
The
that?
only thing I would add to that, is that skillful trial judges not wanting to be reversed by Judge Yates and people and appellate court judges will sometimes correct the record themselves by asking the expert questions. And the questions in the situation that Judge Driscoll just described could well be, why are you employing the fair value when whatever the authority for applying the fair market value exists? And if you don't know the answer to that question, again, your performance will be at best D-. And if you don't apply it and it gets into the appellate court, you could the D- could be demoted to an F.
Well, that's exactly what happened in a Virginia case where the standard of value in divorce is intrinsic value, and I used the intrinsic value. The opposing expert used fair market value. The judge pointed that out and literally dismissed his entire opinion.
Right. And also, I would just add that you better have looked at the contract. If there's a contract, a statute, not likely there is a statute that governs which standard of value to use, because there's just very few cases that say that. But there may be a contract that says it, if the drafter knew what they were doing and knew what the law was. So you consult the authorities that exist, whether they be contractual, case law, or statutes, or even constitutions occasionally, and be sure that what the opinion you have is consistent with that which is required by whatever authority exists.
Thank you.
Judge, you really do run a risk if you do apply the wrong authority, not just with respect to the case that you're opining on right then, but down the road also, because in the internet age, there's just a couple of Google search terms. Everyone's a couple of Google search terms away from everybody knowing everything, including a judge discrediting your opinion. So not only will you potentially lead the judge in the wrong direction, or in a direction that the judge won't let you even lead her or him, but in the next case that you're trying that you're opining on in that jurisdiction, you may well be facing on cross-examination, hey, wasn't your opinion in XYZ case rejected because you applied the wrong standard?
Judge Yates, do you want to comment?
I'm sorry, I just jumped in. I don't even know what the question was. Let me just pick up the flow on the next question. Sorry.
That's the world of the appellate judges, right, Judge Yates? You just say whatever you want to say. We'll all hear it. I say that with a smile, and I love Judge Yates. I'm so happy he's joined us. And I love all appellate.
Well, let's give him a fair shot on the next question. When I'm talking about credibility of the expert witness, business valuation standards now require the business valuation analyst to consider specific procedures in the development of the opinion of value. How does the court determine the extent the expert witness applied the business valuation standards in the development of the business valuation opinion? And how does the trial judge obtain sufficient information to know the standards governing the development of a supportable business valuation opinion?
That's actually an easy question for me to answer, because the standards have to come from you. As comfortable as the three of us are with valuation, I would say that we're comfortable with the mechanics of it, but not the standards that govern valuation. And as a result of that, I rely on direct and cross-examination to flesh out the standards that I need to know. It's really no different than in malpractice cases, for example, where a lawyer will testify as an expert or a doctor will testify as an expert about what the standard of care is. That's something we don't innately know, and we don't pick it up readily from even reading cases if we were to try. So you have to help us out with that.
I just saw, a foundational question, Alan, in the chat about, what the difference is between fair value and fair market value. And of course, none of us judges are professing to give legal advice or an interpretation that applies in even our own jurisdictions, much less any other jurisdiction. I would commend everyone to Chris Mercer, whom all of you know, who published a wonderful book. Let me make sure I have the right title of it. I think it's called Valuations Speak, about 10 years ago or so, and analyzing somewhat the difference between fair value and fair market value. Obviously, fair market value, much more of market-driven concept, and it is intertwined with fair value, as Chris points out, and as many cases point out. But fair market value, I think, might be more inclined to go with a market-driven approach, comparable transactions, than perhaps going into perhaps a more esoteric number-driven approach like a discounted cash flow. I think that I'll give that as the sort of the 98-cent answer.
Outstanding. That demonstrates clearly that we have a duty as appraisers and expert witnesses to make sure the court understands the nuanced differences. There is a whole world of case law out there that deals with fair value and fair market value, and there's a world of difference. And the ABA and the American Law Institute have published a uniform guideline to define fair value in contrast to fair market value. I'm thrilled. We now need to have another session dealing just with those differences. Judge Platt, did you want to comment on this question?
The only thing I would add to it very briefly is, again, look at the authorities that some of which you just mentioned, and do not, and go back to what Judge Driscoll said, don't assume anything. And even if you did assume it, don't assume that the record reflects it, and leave it at that. There's some case law evolving, particularly in Maryland, which just went from Schrey-Reed, which is to Dalbert, and they, like less than a couple of weeks ago, came out where the intermediate appellate court essentially said to a trial judge and reversed his decision because he had acting as a gatekeeper, he had rejected an opinion because he felt the data was insufficient or to do so, and they said, no, that's for a jury or a judge if there's no jury, not for you as a gatekeeper. And that needed to be understood. It wasn't until now, but it is now. So you've got that kind of thing going on that a lot of judges had said, well, your data is incorrect or insufficient or both, and rejecting the opinion and not even allowing it into evidence. They just said, you can't do that.
Well then, thank you. I want to go backwards. Yeah, there we go. Business valuation theory. There's a lot to it, and we're going to hear about cost of capital in a little while. But the cost of capital is used to determine a theoretically appropriate required rate of return. It's the discount rate. Now, there are several methods of determining the discount rate applied in a business appraisal. The experts will often determine substantially different discount rates, resulting in substantially different valuations. So how does the trial judge obtain sufficient information to evaluate the basis of the differences between the experts' calculations? How much knowledge does the trial judge need about business valuation theory? We can talk for an hour of that.
So discounted a discount rate is really the most esoteric of esoteric principles, right? Business valuation is esoteric in any event, and understanding discount rates can really get even beyond that. So I think you have to, as an expert, you have to take it in baby steps. And as judges, I know what I do, and Judge Platt alluded to it earlier. We're going to ask questions, particularly if we are the trier of fact. If we're the trier of fact, if I don't get it, well then I'm not going to give you the best decision I can give. So I'm going to ask questions. In a jury trial, and I don't think I've done a jury trial where a discount rate has come before the jury, but I'd be looking to see when the jurors' eyes are glazing, and I might just try to ask a more nuanced question to try to get to, as my Irish grandmother said, to get to the tachlis of what we're talking about. So tachlis is, by the way, Yiddish for getting to the point. So I think it's so important to take it in baby steps. And if the judge asks you a question, dear ladies and gentlemen who are going to serve as experts, don't patronize, even if it is the dumbest question. And don't suck up either. Oh, Your Honor, I'm so glad you asked that question. No, just answer the question. Answer the question. It's a good question if we're asking it only because we're trying to get to the right principles to make the right decision. Again, the point we made earlier on, to try the case once.
Yeah, a broad difference in discount rates proposed by the experts is particularly maddening because it drives such huge differences in the outcome. I've had to make that decision 3 times, and what Judge Driscoll said is exactly right. If you can explain it to us in a way that we can readily understand it, we're far more likely to go along with the discount rate or something like the discount rate you propose, because it always seemed to me that coming up with the discount rate involves a fair bit of art as well as science. And so I always felt that I had some latitude to make my own determination about an appropriate discount rate, particularly in one case where I thought neither one of the discount rates proposed made any sense at all, and they were at such great variance.
And the explanation, I would think, would be much more persuasive if you can couch it in terms of the choice of your method of calculation ultimately produces a result more fair than the other 2 or 3 or whatever the choices are.
I want to thank you. Judge Yates asked me if to make sure that we covered the valuation report, and we're going to run out of time if we don't skip. So I'm going to skip a slide here and go to the valuation report. Let me ask you.
It was Driscoll, not Yates. Yates is way too smart. He doesn't need to. It's just me.
Okay, let me just set this up. A detailed valuation report is structured to provide sufficient information to permit users to understand the data, reasoning, and analyses underlying the valuation analyst's conclusion of value. Under the business valuation standards, a valuation performed for a matter before a court is exempt from the reporting provisions of the professional standards. What is your view of admitting the valuation report into evidence, and do you review the report to assist in developing your decision?
I think Judge Yates, even though I proposed this topic, Judge Yates has educated me so much on this. I'm gonna be Driscoll on Yates. That you know, the more we have in front of us, the better. Even though technically that report is hearsay. So I'd be asking the lawyers, please consent to this coming in evidence so I can reflect on this at my leisure. And so I think it's so important in your reports to anticipate that and to make it easy for someone to understand, perhaps an executive summary at the beginning of your report, perhaps some bullet points so that we can seize on that when and if that expert report comes in evidence.
Yeah, Judge Driscoll has it exactly right in my estimation. Unfortunately, expert reports generally are treated as hearsay, and so they're inadmissible. But I've had lots of bench trials where people trust me enough to figure out what's in each one of the reports that they'll consent to the admission of the report. And in any event, I always tell them to at least mark it and let me have it as a demonstrative aid so I can follow along. And if you go read my opinions, I'm not suggesting you do that, but if you were to read my opinions, you'd see that I routinely, in written opinions, findings of fact, conclusions of law, and verdict, will pull portions out of the reports and actually reproduce them exactly as they are in the report to explain where I agree or where I disagree.
Judge Platt, did you have a comment?
Very seldom is there an objection at this to the reports, even though it's objectionable for the reasons that they're already stated. That said, when it is objected to, then what my habit was, since I wanted to be able to look at it when I was doing my decision, was to ask the grounds. But the rules of evidence control, and you don't want to put yourself in a position where you've done something that is contrary to that. But there's a million reasons why you can let it in under the prior consistent statements, prior inconsistent statements, all sorts of stuff that if you at least let the part in that you care about. But my experience is, particularly in the last few years, there's very few times where there's an objection that that is articulated under the theory that if the judge wants to see it, I'm not going to tell him he can't.
I want to thank you, gentlemen. It is absolutely a pleasure to have your input into our profession. Michael Kaplan asked to have a minute or two, and we're just about out of our time. Michael, go ahead.
I will do it quickly. Number one, I have found it just very, very valuable having worked with each of our three judges, Judge Platt, Judge Driscoll, Judge Yates, over a number of years. Candidly, it's been my experience that they have a much better command of business valuation, the nuances of it, the intricacies, the process we go through, our standards, than most of the judges I encounter. Now, and they've been very, very supportive of the NACVA and our programs. And for those of you who want to hear more from our three judges, stay tuned in December at our December conference. We are going to be revisiting the presentations that we did at the August conference. So if you didn't see them, or if you want to learn more about it, I urge you very, very strongly. Every one of the presentations that has involved our judges has been very valuable, and we look forward to seeing you there.
Thanks, Michael. So good. And I look forward to seeing you all there.
We're open to putting the program on the beach, by the way.
I'm looking forward to seeing all of you in Fort Lauderdale also. So it's going to be fun. So I appreciate you. Always a wealth of information and guidance for us as a profession. I appreciate all the judges and Alan for running this segment. So
it's my pleasure.
We're going to shift to our next segment. This one is going to be really interesting. I want to hear, because this is a very critical area of valuation. I'm going to introduce a friend of mine, Melissa Gragg. You are in the house. I'll let you take it from there and introduce your guests.
All right. Well, we're not going to waste a lot of time, because we're actually going to get a little bit of a sneak peek into a more in-depth part of the cost of capital navigator. And I have Carla Nunes and Kevin Madden, which I think you guys have seen before. And they are one of the managing director and director of Kroll, and really are liaisons to understand the valuation nuances within this navigator. So you guys take it away. What I'm going to be doing is moderating some of the comments. So if you have questions or comments, go ahead and put them into the chat or the Q&A, and we will get them answered, or we'll respond at an appropriate time to answer them. All right, it's up to you guys now.
Excellent. And Kevin, I mean, this is just our bios are here if you need to look at that. And we'll start just by giving a little bit of a background, because I think Judge Driscoll had an excellent point, and I'm not trying to suck up, but it is true that cost of capital can be challenging. And part of the reason, honestly, is because we're trying to predict the future, right? We're using the cost of capital in the sense of, like, here's a discounted cash flow analysis, like, here's the cash flows that I'm projecting. And then you're trying to bring those cash flows to the present value, right, to today, based on the risk of those cash flows. And so that crystal ball that we're trying to guess what that is, what can we do? We can use models that try to describe what that risk is, but none of them is perfect, first of all. And so there's no unique or single cost of capital. And even though we're producing the cost of capital navigator, number of data points to help you make that estimate, I personally do not believe there's a single number that is the perfect or the unique or the only one, because none of these models are perfect. So what we have to try to do is triangulate those models and try to get to a reasonable assumption for your analysis. And so this is the point about the betas. So we're going to focus on betas. The betas is just one of the inputs on cost of capital. And what we're trying to accomplish here is with this new module that we're going to launch is help you select better beta estimates. because they're actually different depending on the methodology used to estimate them, because they're models, right? And they do change over time. If you're in circumstances like, COVID is a perfect example. And then we'll just touch a little bit upon with the fact that some people will say, well, I don't use betas, I use a build-up method. But why do I need a beta? So we'll just touch on that. And then Kevin will go over like some of the screenshots of what it looks like. Not everything, but we'll have a full session, Jim Harrington and I, at the NACFA Super Conference in Park City. Will be there in person to go, just theoretically, not about the navigator itself, but like how to estimate betas and select them in a better way. So anyway, so next page, Kevin, okay, this is just to show you what happened during COVID and why does it matter? So this, what we're showing here is US industry betas, and they are computed over a 5-year period. So it's a trailing 5-year period. Now, this would be very different if you were to compute them over, like, say, a 2 or 3 year period. Just to show you the methodology and even the assumptions you use to compute betas can give you a dramatic different result. So on the first column, we have betas pre-COVID. So that was as of December 31st, 2019. And then we're showing you what they were fast forward to June 2022. So the most recent quarter that we have updated this data. And so what are some of the observations? We rank the industries or the betas by the ones that drop the most, and that's on top, to the ones that increase the most. And so pharma right there is the one that's dropped the most. And part of that might be the fact that pharma companies and the COVID vaccine, right? Like they were so, even when markets were coming down, for example, or fluctuating, pharma companies were less sensitive to the overall market. Because let's face it, they had a lot of them had these huge contracts for vaccines related to COVID, treatments related to COVID, et cetera. So they became less sensitive to what the overall economy was doing, okay? Even telecom, like the second line there, it dropped a lot because people during the lockdowns were so, they didn't have anything else to do during a part of the time. So they were binge watching, right? And so the telecom industry became less sensitive to the overall market compared to what it was pre-COVID. If I flip to the last two items on the screen, which is in energy and retail, and yes, both energy and retail became more sensitive. They became more to the overall market and to the overall economy, especially retail. If you think about it, all of those retail stores were closed, the restaurants were closed, etc. So any new news that were coming to the market had a big impact. The betas for these industries were moving more than the market, up or down. Okay, so that's just to show, like, you have to be careful where you are in the cycle, where you are during the economy, because betas change over time. They're not always the same. Kevin, I think we can go to the next one. And so for those people who say, like, well, I only use a build-up method, so I don't need a beta. Why do I worry about this? But you might be doing something like an industry risk premium, right, in a build-up. A lot of people will do, at least of the people I talk to. And so in that case, like, we should know, how is that industry risk premium estimated? And so if we go to the next slide, we can show you that the industry risk premium is really just a beta adjusted for whatever your equity risk premium assumption was. So it really is just like a function of it converting a product, like that times beta times ERP, converting that into an addition. So the risk premium for industry, or the industry risk premium, it really is just a beta adjustment. Now, there's different betas that you could use for that. And there are two lines to this story. You either have really good comparable companies that have the right betas that are comparable to your company. So you might have a small group, or, no comparable company is really good or comparable to your subject company, in which case the theory says go wide, go to like a really big group of companies, an industry at the higher industry level aggregation, and that's when this industry risk premium might be also very useful. So even if you use a build-up method, inherently, even if you were not aware of, you are using a beta estimate. So, Kevin, I think before I turn it over to you, I just wanted to say one thing. So what are we trying to accomplish here? We're trying to give you tools. So we know that, Bloomberg is very expensive, Capital IQ is very expensive, and ultimately, even if you go and get some betas from the web, you might not really know whether they're good, reasonable estimates for you to select. So what we're going to try to do with this is giving you tools to say, first, like there's multiple methods to estimate betas, we'll give you that. And second, we'll actually give you like some statistical considerations to say like, well, maybe you should be, this beta maybe is not a good beta because from a statistical standpoint, it's a very poor estimate, has a very low t-stat from a statistical lingo perspective. So we will be able to give you all of that information at your fingertips so that when you select your comparable group of companies, you say like, oh, that's a bad beta, I'm going to throw it out. And then also making some adjustments that are more forward-looking, because historical betas sometimes have a lot of noise to them, and you really ultimately are doing a discount rate for the future. All of these inputs in cost of capital should be forward-looking. So what do I do for a forward-looking adjustment? So Kevin, take it away.
We might have one good question to ask right before we get into it in the chat, which is in this time period when we have sort of, volatility economically, or in a period this person asked in a period of shock or structural shift, would you consider using a 2-year weekly beta versus a 5-year monthly, or would you advise looking at the data in a different way?
That's an excellent question, actually, because I've been having the same exact discussion with our project teams. And right now, the 2-year weekly is not reliable because it has too much volatility in it. And if you're trying to estimate what the beta will be for a business into perpetuity, right, over the next 10, 20, 30 years, this is probably not the best estimate of risk. So yes, at this point, I would focus on a 5-year beta, monthly beta. I often say you should be looking at both because you want to see if there's anything odd that happened, in the last 2 years versus the last 5 years. So in stable times, maybe 5 years is too long to be predictive of the future. But in the current environment, I would put less weight on the 2-year beta, personally.
All right, so before we go through some of the concepts and mock-ups, maybe we'll start with how did we get here? So starting late last year and into this year, we conducted a market study. And so there was kind of 2 phases of the market study. The first phase was to understand the demand and if there was a need for this product. And we quickly learned the answer was yes. And so then we jumped into phase 2 through various customer interviews and surveys and whatnot. And we got a great idea and validated what are our end users and customers' needs, and really to confirm the importance of those features, functionalities, the various data sets, et cetera. So that really helped shape exactly, again, the concepts that we'll see here today. And, as we go through this, we'll make this a real interactive session. If you have any questions, feel free to jump in through the chat, and, hopefully we can answer this. Again, as Carla said, these are just really, there's lots and lots of screenshots that we have that we'll pass off to our development team to continue this. But these are really just the high level screen shares that we want to share. And kind of to reiterate what Carla said, what is the product going to be? What are we trying to accomplish here? What are our goals? And so I think another way to word this is we really want to provide a simple, visual, and flexible tool and data set that enables our users and customers and our colleagues at Kroll to calculate levered and unlevered company betas. So that's what we're trying to accomplish here. So this is where you would land after launching the beta module. Again, it's going to be a standalone module. You'll be able to subscribe to it individually or with some of our other products, but we've set this up similar to how our other modules and products are lined up, where we kick it off with general inputs. What are some of the high level questions we need from you, just to really pinpoint just to the individual data sets and for some consistencies and whatnot. But these were some of the main important factors to help us to define, exactly the list of companies that you'll end up needing to generate those individual company betas. So first is going to be your valuation date. The second will be the currency of our discount rate, our WACC. And so, Carla, why is that going to be important? Why are we asking that question?
Well, so the sensitivity of a stock or a security relative to the index, the benchmark index that is being used, will look very different depending on the currency. And so some of you may actually be doing, valuations where there are some players that are not located in the United States. And so it's very important that there is consistency between the currency of the index and the currency of the security that you're looking at. And that's what corporate finance will tell us. But it's very easy to forget because we're just used to I'm just going to regress this, a company against the overall index, and not even thinking that in a global world like it is today, not all of our comparable companies might be located in the United States. Some of them may be players elsewhere, maybe in Canada or in Europe or somewhere else. And so that's what this becomes. So what we're trying to make sure that we have here is that corporate finance is always respected. All the principles are respected, and that there's consistency here in terms of currency. And then you obviously you can select the frequency of returns, but we'll impose some sort of sample size requirements where we'll say if it's below a certain number, you don't have enough returns to actually compute something that is statistically significant. So we're trying to help in that process when you're selecting your inputs.
Right. Yeah, so some of the currencies we'll offer right at launch will be United States dollar, Canadian dollars, euros, British pound, etc. So a lot of the key developed and developed country currencies will be offered, as well as I don't have the exact count, but there's going to be a decent amount of currencies offered. As Carla said, we'll offer weekly and monthly return frequencies to calculate betas, and then our look back periods will be 1 year through 5 years. So, example, a 5-year monthly beta would be calculated using 60 monthly returns. And then our subject company location is really driving what market indices we'll offer. So, in this example, my subject company is in the United States. A logical market indice to regress your betas against would be a U.S. market index. So a lot of times people will use the S&P 500 or another U.S. market indice, example, the MSCI USA market index, or another to capture again where that subject company resides. Another example of this. For your subject company location would be if you're in Belgium. And, again, some of the market indices we'll offer for that country would be, obviously the first would be the Belgium local indice. But maybe the constituents in that are too small. And so you'd want to go a little bit larger, and you'd go to the a region level. So, the Eurozone would be a region to measure and to regress against, or even go even broader use the world index again to regress your betas against. Carla, any other comments there?
Nope. I think
Okay.
we could give in the interest of time. Yep.
Yep. Okay. So next, once you've selected all your inputs, we get to what we're calling this company picker, or add our comparable companies. So some things that we'll offer to help filter down to get to your peer companies will be searching by company name, number of observations, the industry and GICS code, some keyword searches, and what's not shown here is we'll be able to search by various levels of income statement or balance sheet items, for example, EBITDA or sales, total assets. So again, you get to really hone in and filter down to to select the companies that you'll be adding to your analysis. Once you've done that, we'll start to calculate betas. So in this screen here, we see below that we've right off the bat we'll offer these default betas and probably more when we get to launch, but I believe we're going to offer 6 different levered betas and unlevered betas, including OLS or ordinary least squared regress betas, some betas, facet check, peer group, and more. So for each company, again, depending on the availability and the scenario of your general inputs, we'll offer these levered betas and for each constituent or for comparable company that you're selecting. And then here on the right, we'll provide some summary statistics of those betas and of those companies. And then as you go through the module, some of the big sections or areas to review are, again, once you've selected your general inputs and at least one company, you'll be able to see our levered betas. I'll skip over beta statistics here. The inputs used to unlevered betas, and then obviously the calculation and what those unlevered betas are, and then if you choose to relever your betas. So it's all just the tool functionality from start to finish as you scroll down. And then we'll have beta statistics showing some statistical significance of those betas. One being right here, we're showing the number of observations, but we'll provide some other measures, including T-stats and whatnot. Again, if to help you identify if this is a statistically significant beta or one that you want to quote throw overboard. So. And finally, once you're completed, all your betas and analysis you completed here in the tool will be exported to Excel. So again, at a very high level, this would be the from start to finish flow. And again, the true product here is really to deliver levered and non-levered betas with some with a decent amount of features and functionalities that we haven't outlined here, but know that there's going to be a lot of called bells and whistles to the tool that will help you kind of navigate through from start to finish with some great things coming. So, Melissa, any questions?
Yeah, we do have a couple of questions that have come in. One, I think we can talk a little bit about the industry classification. I think that some people, like the NAICS codes, but maybe you can talk to us a little bit about the classification codes.
Sure, and I do think that this module will make it easier to search by keywords and like finding companies that are more within the subject company business. So maybe that will alleviate a little bit the issue of GICS codes. So the reason why we decided to switch away from SIC to GICS codes was really because the GICS codes really reflect today's economy. The SIC codes have stopped being updated for decades now. and they're not keeping up with the new economy, like, the technology, the communications, etc. Whereas GICS code is the state of the art used by all, asset management and investor type services. And so we decided to move to that. Now, I understand that, you want sometimes to be more granular. And we've recently added more granular level to the GICS code, so it's not up at the big level. So if you haven't, tried that, it's now going down to a further detailed level. But we do want to have at least 5 companies in each of those groups, because otherwise they're not statistically significant. So that's the one thing. So we're trying to keep up with where the economy is trending. Having said that, I do think that this company level beta allows you to customize more to the subject company, because it allows you for word descriptions. It allows you for, size screens or filters. So I think that will help. Yes, here. So, yes, you can search by industry, but you can also search by keyword, right? So I think that will help with that search to be like more to your subject company. Hopefully that helps.
Well, and as they kind of create a peer group or an industry beta by using the size component, I think we had a question about, are you going to still apply the size premium in that capacity? Do you have any thoughts on that?
Yeah, and that's a great question. And part of the reason of the size premium is that people claim that, and it is true that small companies, OLS betas, so historical betas, tend to be understated for the very small companies. And so, so this is why, for example, the risk premium report uses some betas. And yet there's still for the smallest of companies, there's still a size premium in there. So yes, there should be a size, there should still be a size premium. And what all you're doing is you're matching your subject company's risk. And then the only question is which method you're going to use to estimate that beta. Because there is a difference, in size premium being, size premium in some betas versus OLS betas. It could be, it could be different for sure and it would be different for the smallest of companies. But a size premium is still appropriate. It's just making sure that you match the type of beta estimates, how you compute it, with the right size study. So the CRISP size study uses OLS betas. And so, and it is adjusted for the companies that are in those buckets. So those companies will have those smaller betas. So it is absolutely appropriate to still apply a size premium. But if you want to use the risk premium report, then you want to use a sum beta to be internally consistent with that study. So that's the consistency, like understanding what the basis for each of the studies is important.
And there's always education, because what you clicked on, I think in one of the slides, was that you can read more about the betas and which is going to be the most appropriate use. I think somebody asked, is there going to be additional like statistical information such as the standard error of the estimate or anything like that? Is that something that might be included when we actually get into the module?
That's the intent. Now, we might have to do a phased launch because there's a lot of data. So what we call the most viable product. So the first launch may have a few things missing, a few of these statistics and features, but the intent is to have, yes, both the t-stat and the standard error of the estimate. Yeah.
Okay. There was a couple other questions. I think that some people were kind of struggling with these different time frames of looking at the beta because of so much volatility. And we're questioning if even a 5-year would be a reasonable, and I guess I'll respond a little bit, but maybe it'll assist you. Like, I think that you have to look at the industry and you have to look at, how has the beta shifted over time, and in the different, variations in order to understand how, I mean, that's where your, as a professional comes in and how does this affect or matter to your specific company? So I think that, you have the tools here, but you have to take those tools and say, okay, over the wide scheme of things, do I believe that this is representative? So I don't think that it's just the end all be all tool. Like, it's a tool that we then also need to understand in context. I don't know if you want to add any additional layers of that.
I mean, that's an excellent point, Melissa. So I personally, when I look at betas, I actually like to see them plotted over time. Like, I have actually do it over like a 10-year period. And I will see like what is it, a monthly beta versus a weekly beta. And of course, taking into account number of data points, because that's important for the sample size. And I can see sometimes there's a breakdown. There's like a company that will completely go up or completely go down, and something happened. And as an analyst, I wouldn't know what happened here. Or is it happening to all companies because of something like a structural shift? And in a given industry, maybe there is a significant shift. The underlying risk of an industry is now different. And that's, the more recent period will reflect that. Or is it the case that, this is like a financial crisis, for example, and then it's going to go back to where it was before. And when we teach at our new hire training, we always like to show like Bank of America as a beta over time, and how it was like below 1 and then increased like way above, above 1 during the global financial crisis. And then it took a while to stabilize, and now it has been stabilizing again. So I think those plots really, really help to see if there's like a discontinuity in that company's beta. And is it like true for all the industries? I mean, for all the companies in that industry, or is just like a one company because, they're at risk of bankruptcy, or they made a big acquisition that changes their risk profile. So something could be happening with that company that is not happening to the rest of the industry. And that's why I love those plots, because they really tell me, and that's something that down the road, we really want to make that available as well to this module. So you can see that yourself, like you can see a company, you can see how the beta over time plotted. So that's, there's no unique answer, but it is definitely something that it requires judgment when you're doing that selection.
I think somebody had maybe a suggestion or was wondering if in the future, if you will be having like revenue beta and EBITDA betas for contingent consideration valuations in this tool. That's a long question, but I don't know if that's something that is on the forecast. Okay.
So it's actually something we're considering, but that would not be for this particular module. We're considering having like an additional, we've been talking about it, an add-on to module 1. So the US cost of capital. And we've been talking about looking at the data that we have since 1963 to try to compute those revenue betas and EBITDA betas. EBITDA we're still debating, but definitely revenue betas for purposes of contingent consideration. We're definitely working on it.
That's awesome. I think we've answered the majority of the questions, and we're kind of getting to the end of our presentation. People can certainly reach out to you, maybe if they have suggestions. Maybe you get a lot of suggestions. But they also said that plotting the betas is a great idea. So I think that was a good takeaway from this section is, like in a time period of volatility, start to look how, like anything that we look at, like how has it changed over time and what information does that provide for a forward-looking beta? Well, thank you so much, Kevin and Carla. Do you have anything else? Because they're not coming on to kick us off, but they will. And if you have anything else to offer, please do.
Yeah, no, the other thing is, in terms of selecting betas, I would just say, if you are able to go to the super conference in December, that will have like an hour for you or whatever to just talk about some of these things in more detail, like on selecting betas from a theoretical standpoint. So I hope that's helpful.
Yes, thank you.
Thanks, Melissa.
Thank you, Melissa and Kevin and Carla. We have one of the polling questions right now, so make sure you respond to that. And now we are going to have Chris Hamilton. He is the principal of Arxis Financial, Arxis Technology, and Arxis Wealth Management. These firms are involved in tax and accounting consulting, business valuation, litigation consulting, and technology consulting. Mr. Hamilton has presented courses at international conferences, training institutes, and seminars around the country. And now he's going to be talking to us and giving us insights on inflation. So, Mr. Hamilton, welcome. You're muted. We cannot hear you.
Yeah, I'm new at this.
Oh, thank you.
I'm kidding. Sorry. This is only about the 1,000th Zoom I've done. I apologize. I started off saying good morning if you're in my time zone, or good afternoon. It's an honor to be here, and I'm just going to jump into it. I have a short amount of time to talk through the issue of inflation and talk about the impacts of inflation on how we value businesses. For decades in this country, inflation transitioned from a memory to really economic theory. It has been an extraordinary long time since we've had inflation like we're seeing right now. The 1970s and 80s were a long time ago, and I remember them. That's how old I am. But inflation hasn't been a significant or a volatile factor in our economic consciousness for a very long time. In the last 40 years, the role of the Fed has changed. Interest rates and several other factors have been highly manipulated and controlled, all to avoid out of control inflation and deflation. There's always inflation. And for 40 years, basically, the Fed has set targets for inflation and been able to manage accordingly. So today is an opportunity to think a little bit about how inflation affects or doesn't affect valuation, because like it or not, inflation is here, significant inflation. And my goal today is to raise more questions really than answer them. I want to prompt some thinking and caution you as you prepare valuation reports in the midst of economic conditions that we haven't seen in 40 years, and they're not going away for a while. Inflation has been called transitory by our Treasury Secretary and Fed Chairman, and I think we all understand now it is not looking like it's going to be transitory. So half the battle is to ask the right questions. And the first question in the first slide is, what is inflation? And in short, you can see it, it's too many dollars chasing too few goods. And this is a basic question. That is a very basic definition. But at its core, that is what inflation is. And historically, inflation is an economic phenomenon created by government. That was true in this country in the late 70s. And in the early 80s, there were severe fiscal policies implemented by government to kill inflation, and it worked. And since 1980, there's been coordination and control of the economy to an extremely high degree. And it was generally accepted that inflation was the enemy. Nobody wanted it. Starting in 2020, you could not have had a more textbook setup for general economic inflation than what we've watched and experienced. And if you think about the definition of inflation, too many dollars chasing too few goods, it's not hard to have predicted, as many people did in 2020, that we were going to have inflation. In 2020, we were introduced to the wild proposition that it was a good thing to shut down all means of production and supply, while simultaneously injecting trillions of dollars into an economy in the form of PPP loans, unemployment compensation, rent subsidies, food, and other handouts. And that extraordinary injection was then followed by further limits on production, depending on where you live. I'm in California, and we had ongoing lockdowns until probably pretty much through 2021. Then the next hit to production was the political decision to shut down industries, such as farming, in some places, oil and gas production, as well as major labor interruptions. And so what you have now is the perfect storm of too many dollars. The government has printed trillions of dollars in the last 2 years or 3 years, And by the way, I'm not being political. When I'm giving you that time range, I fully recognize, and I think you should too, I'm talking about administrations and from both political parties. So this is not a political speech. This is just a fact that since 2020, there's been extraordinary amount of money injected into the economy, while simultaneously production or the supply of goods and labor has been severely limited, and here we are. Inflation is real, and it will be devastating, disruptive, and destructive for businesses. It's also going to be very advantageous and beneficial for some industries. There were trillions of dollars created out of nothing, and that's coursing through an economy concurrent with labor and material shortage and supply interruption. But some industries are benefiting from the injection of cash flow without experiencing debilitating labor supply problems. So now I want to start to draw a distinction. The definition of inflation is too many dollars and too few goods. Inflation is not high gas prices, it's not high interest rates, and it's not recession. Those are all consequences of inflation or the response to inflation. And I want to draw that distinction because, just to throw back to 2020 one more time, there was an extraordinary interruption in the normal economic cycle. None of that was caused by a virus. What caused that was the response to the virus. And as economists, and I'm assuming everyone watching here or listening is an economist, you do business valuations. And your job and my job is to understand what's going on and to be able to articulate it and explain it accurately, and to call all of what happened in 2020 and 2021 caused by a virus is oversimplification. No, what it really was is what was the response to the virus, and how did that have an economic impact on businesses? So you have too many dollars chasing too few goods. You have evidence of inflation, which is rising prices. You have evidence of inflation, such as increased gas prices. You have shortages of people and products. You have disruptions, and you have damage. I was just talking on another webinar I was just on about here in Southern California. You have a hard time right now consistently finding an open Starbucks store. We came to understand that Starbucks was ubiquitous. You go there anytime and you can have a business meeting and a cup of coffee. Well, there are some significant Starbucks locations here in Southern California that are not open 7 days anymore. And you never know when you think they're going to be open that you might not show up. And there's a sign on the door saying closed because of an inability to get product or to find workers. That's not inflation. That is a result of inflation and the economic circumstances that led to inflation. And by the way, the cost of coffee is going up. So there's consequences, and there is a response to the problem of inflation. And historically, those consequences, including tax, fiscal, and political policy. Another consequence of inflation sometimes, and almost every time, is recession. Then there's deflation. There's stagflation, which is the perfect storm, which is probably where we are right now, where you have price inflation with a contraction of the economy. So that's kind of a background and a description of where we are. Our job is to keep inflation and the causes and consequences of inflation separate and clear in our minds. And it matters. All of that matters because we have to make assumptions and decisions in valuing a business and then telling that story. So let's talk about the variables affecting value. Not every business is worth less just because of inflation. In fact, it may be that no businesses are worth less because of inflation. Inflation is a general increase in asset prices. The value of common stock may be increasing. The difficulty is the ability of management to respond to and react properly to the causes or the results of inflation. And that may be what actually impacts value more. So the downstream secondary explosions, if you will, from the initial bomb of inflation are things like rising interest rates. Rising interest rates are a response to inflation. That is the move by the Fed to slow the growth of the money supply. It is a means of killing inflation. If you were around as long as I've been around, you remember in the early 1980s, the Fed cut interest rates raised interest rates, in one day by 5 percentage points. That had enormous impact on industry, negative impact on some industries. And it's important as a valuation expert to say and to understand the impact of that wasn't from inflation, but it was from the increase in interest rates. So it's important to understand what's going on, to read, to ponder, to observe the economy around us. And there's 3 ways to account for any variable in a valuation of a business. You can account for events through the benefit stream, through the risk rates, or through discounts. And let me walk through those really quickly. And I realize this is very basic, but you have to consider in today's environment, inflation and the consequences of inflation, some of which we aren't even experiencing yet. We're going to talk about that. But will that impact the margins of the subject company? It might actually increase the sales of the subject company. When there's general price inflation, the company you're valuing, depending on what they're selling, might actually benefit from that on the sales side. They might also face higher costs, supply, labor, materials. They may end up right where they were before inflation if they're able to pass all of that on to the customer. Debt service with higher interest rates is going to impact cash flow. The other way that you adjust for inflation and the years of consequences that are going to come from this is to adjust the risk rates. But I want to caution you, risk rates are forever. The most significant projection you make in the valuation of a cash flow is your risk rate. By risk rate, I'm talking about the safe rate plus the equity risk premium plus the size premium, the company specific risk premium, and your assumption on the terminal growth rate. So already big name experts are yelling at us, telling us we need to modify the equity risk premium because of what's going on right now. And as I did in 2008, 2009, when they did the same thing, would throw some caution into that and say, let's be careful. You're imposing short-term conditions on a permanent, we call it forever, eternal risk rate. In other words, you are identifying a risk rate that is going to be used into perpetuity if you're doing a going concern valuation. Discounts is another way to adjust for inflation. I personally have never seen an inflation discount, but as long as I've been around, I know I haven't seen it all yet. So valuations in an inflationary period will be a little different, and we need to think about the most appropriate place to adjust for the effects of inflation. We need to think about, are we overreacting to current realities by how we're accounting for inflation, and are we telling the story accurately in describing the cause and effect of the negative impacts of what's happening to the business, and it may be positive impacts. So valuation 101, I'm going to go back to methods and approaches on the next slide, and you have decisions to make when you consider the appropriate method during a period of inflation. I'm just going to go through this, and again, I'm giving you some opinion and just trying to get you to start thinking about this. If you're doing a valuation using an asset approach, I don't know how in a period of high inflation you can get away with not getting current appraisals. And that's something you need to be telling your clients, that part of the cost of the valuation of a family limited partnership, for example, is you can't use last year's appraisal probably. And if you do, you need to be very careful. The capitalization of earnings or capitalized cash flow method in an inflationary period is highly dangerous, in my opinion. And the reason is there is a growth assumption when you use a capitalized cash flow method where it's income divided by risk. You are making an assumption that growth is linear. The growth expectation is linear. And in a period of high inflation, and I will say high volatility because of the response to inflation, that may be a dangerous assumption. My expectation is in the current marketplace that we're going to see more and more valuations using the discounted cash flow. And the discounted cash flow is appropriate because you're accounting for growth in the benefit stream until such a time when the best estimate of future growth is linear. And I would expect in most industries right now, DCFs are going to be appropriate because you're going to have to account for the impact on cash flow from changing economic reality. And when you convert from income to cash flow, you're going to have a much deeper thought process than we have for a long time, where we've always assumed debt has low interest rates. It wasn't a material factor. It is now going to become a very material fixed cost for companies and a variable fixed cost from the standpoint of how much it's going to be. CapEx, a lot of businesses are going to be modifying supply lines right now and bringing the work in-house, and I'm seeing that even in my practice here. The market approach is really a search for a cap rate, a multiple, and the market approach produces a price. Your job is to consider whether it's really a value and to convert it to a value as needed. And I wonder if it's going to be hard to find comparable risk rates or comparable price guidance in a marketplace that is as volatile as the US economy is right now. And of course, terminal value. Well, going concern, you need to remember inflation historically is a short-term phenomenon. Inflation, there's been 5 periods in the US economy of significant inflation, and they've been relatively short in the grand scheme of things. What isn't short-term is the response to inflation. And history tells us there's going to be a lot of businesses that fail in the coming months and years. You get to decide whether the subject company might fail because of inflation or something else. But when you are looking at going concern, you have to be thinking about that. And terminal value plays right into that. Be careful of everything you include in your terminal value, from a cash flow to a risk rate. Your terminal growth rate, we've been accustomed to using 3 to 4% as a terminal growth rate because of historical inflation. Is that wrong now because inflation is almost 9%? Well, you have to think about that. And remember that your terminal growth rate is based on long-term history. And it's being used to project long-term into the future. You also have to be careful how you tell the story, because if the user of your report is reading every day that there's 9% inflation and you're using a 3% long-term growth projection, you can be wrong by being right. If you don't explain in your report why 3% is still the right number, and I would submit to you that it is, unless you've come to the conclusion that something systemically in the US economy has changed. And in the last slide, as I wrap this up, the tips and traps, if you will, of inflation, you need to consider your cash flow. Inflation, because it's short term, is probably best accounted for in a cash flow projection until you can project that that period of inflation is over, and then you can reasonably expect a static growth rate. There's 3 responses to inflation. One is tax policy. We're already seeing proposals to raise taxes to cool inflation. The windfall profits tax, if you've heard about that, is coming. You have fiscal policy. Interest rates are going up, and they're going to continue to go up, and maybe rather significantly, and then they will come down. And that is going to have a significant impact on most small businesses. And then you have what I call political or legislative policy, where a tighten or loosen regulatory environment, they're already talking about price controls. In fact, Congress just passed price controls in the medical field. That is so classic. All of this, history repeats itself. Price controls have never worked. They create rationing, but that is a response almost every time to a period of inflation. And you need to be aware of that for your subject company in whatever industry they're in. And then you need to tell the story. And I think I'm at the end of my 20 minutes, so I'm just going to say this. Thank you. My encouragement is to read, to think about this, to ponder inflation and the results and consequences, and then tell the story. And none of this should scare you. This issue of inflation, what's going on in the economy right now, actually enhances the value you bring to your clients. And so good luck to you. Thank you.
Hey, Chris, man, so good to have you here. Thank you.
Hi, Mel.
We actually have a couple minutes real quickly. And I don't know if you hit on this at all, but you mentioned discount and inflation for discount or discount for inflation, but not necessarily discount for inflation. But do you see how this could impact discounts like marketability and things like that? Access to capital, those kinds of things, because the discount is access to the value.
Yeah, I talked to a couple business brokers who told me in about a 48-hour period, almost every deal they were working on to sell a business died. And because of the financing costs, and the banks are passing along these interest rate increases immediately, they're stopping deals. And if somebody's buying a business on a tight cash flow margin, any kind of reaction like that causes them to bounce out of the deal. So yeah, it's interesting. It could affect the marketability discount, that businesses may not sell as quickly as they were selling. But we've seen that here in Southern California since COVID started.
Yeah.
And I've seen a lot of marketability discounts because, for example, restaurants, they're just more difficult to sell right now.
Yeah. Now, I know you said you don't want to, this isn't political and everything, but at what level should we as valuators start taking into consideration or talking about how policy is impacting the value, how policy is impacting some of these things? Because if we're looking at we were just in the last session talking about a future look and predicting the future, that policy is going to affect a whole lot of things, and we can't ignore it, can we?
Well, I don't think people are ignoring it, at least in my world. A lot of business owners recognize, I sit on the board of a manufacturing company. I always jokingly say it's the last manufacturing company in Southern California. For 2 years now, they've been competing with the government to get their people back to work. And that's where public policy is highly damaging to smaller businesses, because the smaller businesses cannot afford to do what I saw. I just heard about Chipotle had a sign on the door. They're looking for workers, and they're willing to pay $20,000 for college education just to get people to get a minimum wage job to make burritos. Big business can afford that. Small business can't afford that kind of incentive to get workers in, and they're starting to close their doors. So the small business owners get it. It's killing them. And this is the effects of inflation, and all of this has to get wrung out of the economy. And, Congress has a tendency to say, we got to fix it. And they fix the problem they created.
Yep.
Both parties.
No, I totally agree with you. And unfortunately, I remember inflation too. So that just puts us in the same age echelon.
Yeah, we know what's coming, and it's going to be rough.
Yeah. So, dude, always appreciate you and your knowledge, your wisdom, and how open you share. Thank you. This was probably, like, I think, and see the comments in here, that probably one of the best kind of takes and views of inflation and the breakdown of cause and effect, and what is really just an effect of the inflation and not inflation itself. So thank you for being here.
It's an honor. Thank you for having me. Thanks, Mel.
All right, my friend. See you soon.
Okay.
All right. So we're going to move to, we've got another polling question up. So make sure you get all those answered. And with that, we're gonna move to our next segment, which is usually the segment we start with in the mornings, but we're gonna be bringing on our friend Michael Gregory. Mike, so good to have you here. For those of you that don't know Mike, extremely knowledgeable. He does a lot of mediation, collaboration. He's got multiple books out, and he comes in every session to talk about industry headlines. These are things that you ought to look at, and he gives you the links so you can dig deeper. And so I can't wait for your session. Mike, I'm going to let you take it away. You might want to flip your screen. We've got the presenter view.
Thank you. I know that, and I've seen it. And on the top of my slides, I'm looking for the switch the displays, and unfortunately, that's not coming up for me right now.
If you hover to the display settings, you see that? Display settings at the very top.
No, it's not showing up.
Oh, it's not?
No, I'll stop sharing. Let me just try sharing again. Let's just try it again. Oh, now I've got several PowerPoint presentation slide possibilities. Let's try this one and see what happens. No. Nope.
You're good.
I'm good?
Yep.
Oh, good. Great. Thank you. Thank you for your patience with me. And Mel, thank you for that introduction. And I got to just pause and say, wasn't that fun? I mean, as Chris was talking here, I went and looked up St. Louis Fed is predicting a 10 years inflation 2.5% today. University of Michigan, 10 years, 2.8%. The federal government is predicting 2.4%. So you're involved with these things, and the things he brought up, I was thinking, do some research on this, on what he's presenting. He's presenting very good information for us to think about, but don't forget about doing your own research. So I'm going to get started on my current updates and evaluations, but he was making me think, and I was looking up things myself as he was talking. Several good articles from Forbes on this question too. You might just want to take a look at those. So going into what we're talking about today, you know who I am, and I've been here. So I'm going to go over a number of articles. What young business valuers need from veteran practitioners. Takeaway from NACVA Super Conference. SME transactions dropped to 2.9 as a multiplier. And that makes sense with what Chris just said of people dropping out of things. You'll see it's the lowest ratio in the last 6 years by quarter. Car dealer blue sky values remain at record levels per the Hague report. NATH comments on Hitchner versus DeModern. And a paper explores IPP investments in the US. So what are some of the objectives we're trying to work through today? What do you need to provide young business valuers with what they need from veteran practitioners? Apply key takeaways from NACVA Super Conference. Note the small market equity value, or that index, dropped to 2.9 in the second quarter of 2022. Reference car dealer blue sky values at record levels. Consider NATH. And NATH, we'll get into him, and I have an article from him that's a bit dated, but he's always been a very forward-thinking and intellectual type writer. And just think about what his comments are. And he's commenting that Hitchner versus DeModern, and some comments with respect to both of those. And then download the paper on intellectual property products by the Bureau of Economic Analysis. And I'll just have that for reference for you here too. But the article says what young business valuers need from veteran practitioners is help with communication skills. I come back to, you need to have a connecting relationship. You need to listen actively to each other. And then you need to educate judiciously. That's the collaboration effect. And this is saying that's what we need to do, but also understand what's going on with that with clients. So take younger clients, take younger business valuers with you on site visits, expose them to what it's like to meet with a client in a client meeting. Show them what goes on with correspondents. Have a building rapport on that connecting relationship so you really get to know each other and get to understand each other. Well, that's what the article has. And I'm going to share some things from my perspective for you to think about. I've been working with neuroscientists now for 10 years, been in the private sector for 11 years. And with these 4 neuroscientists, I've learned a lot of things. And I've come back and said, with 25 years management experience, I'm going to share some thoughts here too. This little 3 bullet points. Catch your employees doing something right at least once a week and thank them for that specifically. Now, I had a span of, I went from 9 technical employees plus support personnel to 21 technical employees in 3 different cities, in different states. How could I possibly do that? Well, it became part of a culture to do that. And with folks that are the younger business valuers, They're looking for that positive affirmation. Give me some direction. Let me know what I need to do. Point out and help me and help us work this as a team. Give them the resources they need from their perspective. That means you have to ask them, what do they need? And a lot of work is going to be on what was called the soft skills, that today we call the critical skills. And don't micromanage. I heard a neuroscientist, Terry Wu, talk for an hour, and he gave 2 hours, gave it 12 examples. When he got done, I called him on the phone, and I said, Terry, here's what I heard you say. I heard you say that we all have a stress response. But what that stress response is we want to have a sense of control. We want to have a sense of predictability. We want to have a sense of progress. When you don't have that, that stresses you out. And you want to help reduce the stress on these new employees or newer business valuers by addressing those needs. Give them a sense of control. Give them a sense of predictability, and help them see that big projects can be broken up into a bunch of small pieces. And then give them a chance to shine. And that can be they're in the firm working something as a group. It can be in something they've done outside of work. But give them a chance to shine with what's important to them. And from the standpoint, I was working with the Illinois CPAs. They said in 10 years, they brought on 300 people of color, specifically with internships, and 30 of them become CPAs. They went back and looked at this, and they said, when we bring on people who are of a lower income stream, that's who a lot of the interns were, they need 3 mentors. And what are the 3 mentors? Someone who's there to help you technically. We usually think about that. We've got that covered. But with middle class, if you went to a premier school, you're middle, upper middle class, you also know I need to have 2 other mentors. I need to figure out who really gets things done in the firm and how you get them done. And they also have a visionary, it might be a partner or a senior partner. Or in the American Bar Association, they came back and interviewed a number of folks who were Hispanic. And one Hispanic woman said, when I joined the firm, they got 2 mentors for me who were partners, who I could go to at least once every 2 weeks and talk about what's working, what's not working, how do I fit in? There's things I just don't know. I don't understand the culture. So these are the 3 types of mentors that are needed if you're going to be successful. Oh, now I'm going to move into the super conference that was with NACVA. In the first presentation, it just happens to be, it was mine. And this is what was listed in the series of this article. They talk, mediation is a growing field. That's what I do. I'm a qualified mediator with the state of Minnesota, have been since 2004. I do 2 to 4 mediations a month. I bring on board the attorneys, the business valuers, and the ultimate clients. And they get to hear what's going on. Then the business valuers go away. They're not involved anymore. But the attorneys and clients are. And they work to come up with a solution that everyone can live with going forward. And it's what are the facts, what are the issues, what's the emotion around those issues, and what are the interests, and work that to try and resolve it. We're 98% emotional and 2% rational. Let that sink in. We're 98% emotional and 2% rational. We think of all the numbers and how we got there. You heard Chris Hamilton say, we've got to tell the story relative to inflation. We've got to tell the story relative to this firm. Telling the story is actually the most important part for a layperson to understand. Zoom is here to stay. And a nice suggestion, the screen for the judge and the attorney are under the camera. So they're looking at the camera and down at the screen back and forth. That way they're looking right, you're looking right at the judge too. And fees should be based on value added. Think about what your value added is of whatever it is you're doing and have that priced accordingly. Private equity firms will own more than 50% of the top accounting firms in the next 5 years. Offshore is a model whose time has come. I'm a sole proprietor today, but I have 6 people working for me in other parts of the world right now. That was not true 3 years ago. And I'm just looking at offshore as a model whose time has come. That's really true. Talk to business brokers. You heard Chris talking about when he's saying what's going on right now. He talked with 2 business brokers. Being example of top expert, there's an example. The top expert had to redo his entire evaluation once he talked with a business broker in that area to give him insight. For cannabis firms, very different rules based on the county you're in and then the federal and state laws. In company-specific risk, 15 to 25%. If you're looking to hire employees, how about trying to get some undergrads to work part-time? What you're really doing is you're bringing on somebody who can work with you potentially for recruiting them for the future. Artificial intelligence, is coming on board with auditing and forensics, and valuation's a little further behind that, but that's coming in that area as well. In valuation, something fresh every day. Think about that, how that's a recruiting tool. You're not just going to be doing the same job day after day. You've got a job as a valuer where new things are happening every day. And the war on talent, it's expected to go on for the next 5 to 10 years. And get involved with the professionals that volunteer. There were great examples from Jay Frischman and Chris Mercer on when you volunteer in your societies and within our organizations, NACFA, the ASA, AICPA, when you can volunteer in different areas, you'll enhance your visibility, you'll enhance your skills, and you'll move into more of a leadership position. That will help you as your own personal brand, just your own name, your own personal brand on where you'll go within the business valuation. Use bookmarks as a function in Adobe for headings from Word, and I think a lot of people do that with their reports. Compensation in healthcare is changed to a value-based instead of survey data. Survey data is what was used historically. An inexpensive valuation calculator, they do have their place. And I like the example that was given. If you're sick, one place you can go is go to WebMD. You can go to Mayo Clinic, and you can take a look and say, if I've got these kind of symptoms, what might that be? Well, that can be your calculator that has its place. But when you really want to be diagnosed and what should you do, you go to your doctor, right? So in the same sense, I thought that was a cool analogy. Inexpensive valuation calculators, they have their place. It's like getting something from WebMD. And then, yes, judges gossip about the experts. We had the 3 judges on earlier. Do they talk about what experts they had in their court with their associates and what they thought about those experts and how well they did, how well they were prepared? The commentary we got earlier from the judges themselves, and then Alan Zipp presenting, this is what happened on a case he was at, and this other expert got thrown out because they had the wrong definition of value that was used in the case. Sweet spot for long-term growth is 3 to 5%. This is, again, from one of the presenters. Check the subject industry, check Livingston survey, check governmental sources. So I gave you the St. Louis Fed and another federal source there just a few minutes ago. And that's what this person was saying. In fact, next month, I'm going to share something with you on a study that was done by Roger Grabowski and Ashok Abbott from West Virginia University on what they found on looking at existing versus new firms and what that means in terms of what the growth rate might be going forward. So stay tuned for that one for next month. I was researching that earlier today for next month's session. And then in terms of what's happened with small market equity, far right down there, it says 2.9 is what it was in the most recent quarter, second quarter of 2022. And then look across that chart all the way to the left. And it shows you that it's not been below the number of 3. And that's looking all the way back to the third quarter of 2016. That's a major drop. And you heard Chris Hamilton talk that deals are not going through with these recent jump in interest rates from the Fed. So keep that in mind. The car dealership blue risk values remain at record highs. This is a report. I have a link to this. There's some information on what's happened with those, and I'm just sharing with you. That's what the numbers look like. You've got that. And then Eric Nath, I said he's an academically oriented, intellectual, looked at valuation. And what he says is Hitchner's got what the values of what people have done and how they've done it, but you really have to be looking at a forward rate. When you heard Carla Nunes speaking earlier, says you're supposed to be looking at this for what's a future rate. So he's got some stats in there. He says maybe he agrees with the motor in 35 to 40%. Historical rates are just historical. We've got to be looking in the future. The Pepperdine survey looks at the future. Many folks look at ERP size premium. See his article. He has some myths about that. It's an article from 10 years ago, but it's right on point. Pepperdine's the best source is what he comments on. And look at what implied rates of return are for public companies. Then there's a paper on intellectual property products as measured by the National Income and Products Accounts by the Bureau of Economic Analysis. It's a lot of words there and initials. But plant, property, and equipment, they've gone down overall as an investment. IPP has increased, and consumer services and healthcare is the one area seeing increase relative to plant, property, and equipment. In terms of references for you here today, short-term and long-term inflation forecasts, survey of professional forecasters. Auto dealerships are running hot, and it's $299 for a 2-hour webinar and what they presented in that webinar. Hitchner rebuts the moderate attack on cost of capital. And one of the things that's associated with that article is the biggest business valuation myth by Eric Nath back in 2011. Take a look at that. Pepperdine survey, $125, looking to the future. Understand the Uneven Growth of the Intellectual Property Investments in the U.S. by Dennis Fixler and Eva DeFrisco. And that's 31-page report. You can take a look at that. And then each month, I use these different sources to provide you with information on this quick summary. And again, this is who I am, and you can reach me at my phone number there or give me an email. I'd be happy to work with you at any time. And with that, I'm going to pass it back to, it looks like Elena's coming up. And Elena,
Yes,
you can take it from here.
Thank you, Mike. Thank you for all that information and the summary from the Super Conference. We really enjoy the information that you provide and also the references, because we can go back to that information and obtain more detail. So thank you, Mike. We
My
have
pleasure.
one of our polling questions right now, so make sure you respond to that. And with that, now we are going to have Rowena Figueroa. She's the Director of Outreach and Partnership at Hinge. She is a seasoned marketing communications professional who provides clients with practical advice and support needed to deliver the right message in the right place when their audience needs it. And she's going to be talking about from ordinary to luminary, how every expert can become a visible expert. So, Rowena, thank you for being with us today.
Thank you. It's a pleasure to be with everybody here and to share some of the insights that we have accumulated and collected through our various studies through the Hinge Research Institute. Now, I actually won't be able to do the shifting of the slides. I believe, Chanda, might you be able to share the slides?
Yeah, I will be. Can you see them right now? They should be.
I still see Mike's. Okay, there you go.
Okay.
Okay, so if we go over to the agenda slide, I believe that's slide 3. Okay, so today we're going to go over, what is a visible expert, and then go into the 2 research studies that I'll be sharing with you. One is Inside the Buyer's Brain, and the other is the Visible Expert Study. Then we'll ask and answer the question, why be a visible expert? What are the key benefits and what are the risks when you aren't one? And then how do you become a visible expert? What are some of the techniques that visible experts have used to promote themselves? And then lastly, how do you develop your own visible expert program? So let's go to the next slide. What is a visible expert? Is it a thought leader? Yes, it is a thought leader, but what exactly is a thought leader anyways? If we go to the next slide, it could be a firm or an individual who has attained 2 things. One is the high visibility, and the other is reputation for an expertise within an industry. Now, your reputation has 2 parts in turn. One is the sentiment, which is either positive or negative. The other is the expertise that you are known for. But in short, whether you want to call it visible expert or thought leader, you are a recognized authority within your industry or within a cross-section of industries. You are recognized as an authority by other people within that industry, including influencers. So let's go to the next slide. This is the first source, a visible expert study, where we conducted interviews and surveys of 220 visible experts across different segments. And also we did some surveying of their own providers. And here are some of the learnings from that study. Let's go to the next slide. There are actually 5 levels of expertise. You'll find on the left side, you have level 1, and you are a level 1 expert if you are the go-to person within your firm. At level 2, you've formed a reputation outside the walls of your firm, that perhaps you are known by your clients and or a community of practitioners within that industry or niche. At level 3, you are a known entity within your industry. You're an industry name. At level 4, you're recognized as a leader within your industry. And level 5, you are a leader across several industries. You'll find that the bars on the right side reflect how the participants of this study actually break down. So you'll find that more than a third of them are level 4 leaders, and about a quarter of them are level 3, and 1 in 5 are level 2. So most of these leaders and thought leaders and visible experts that we've learned from have actually gained some renown within their industries. Okay, let's look at the next slide. So what does the research say about the buyers of these visible experts, their clients? So let's look at that slide. We're going to draw on the Inside the Buyer's Brain study, which we just launched recently. We surveyed 922 accounting and financial services buyers, in addition to other industry segments. But for this particular audience, I wanted to focus on this segment, and also 566 of their sellers to figure out whether there was a good match between the two groups' expectations of one another. Okay, next slide. So here on this slide, we see the buying criteria that buyers use to evaluate whether or not they want to work with a particular firm or a particular individual. And these are the top criteria they use. Note that knowledge and expertise continues to top the list. And in fact, it has grown in importance by 28% in just 2 years. What we're finding is that clients are experiencing a kind of fatigue around generalists who aren't able to take a deep dive into the new and evolving challenges and problems, priorities of buyers. Okay, now when we look at the other criteria, like existing relationship, all these other criteria are actually related also to expertise. Like with existing relationships, those relationships would be based on how well your expertise has served your existing client. Talent, obviously, that's directly related to expertise and knowledge. Client service, this is also expertise related, because if you are an expert in your client's issue, you'd be able to deliver those services in a timely manner right when they need it. And what about offers services needed? That means that you are able to parlay your expertise in order to stay relevant with your clients, with your target audience. So what we're saying here is that being a visible expert, and especially one who continues to deepen their expertise, will give you an advantage across the different top criteria that buyers use to evaluate providers that they want to work with. Now let's look at the next slide. This same study, Inside the Buyer's Brain, has shown that the #1 marketplace challenge of all the respondents, and there were about 1,400 respondents all in all, is competition. There's just more competition out there. Ever since we moved online, there have been new entrants because they've been able to establish their visibility online. So 40% growth in just 2 years in the perception of competition as a growing problem. And we'll find that just as competition is heating up, let's look at what's happening to providers' reputation and visibility on the next slide. We'll find here that reputation and visibility are declining. So let's look at the blue line. The blue line shows the percentage of buyers who rated their provider's reputation a 9 or 10 on a 10-point scale, 10 being the highest. We find that in between 2018 and 2020, there was an 8% rise, but then a 2% dip over the past 2 years. So reputation is going down. The red line is a little more alarming because it shows from 2018 to 2020, a 14% rise. Okay, so that's a good thing. But then that rise over the past 2 years has been completely erased by a whopping 20% drop from 2020 to 2022. Okay, so let's look at the next, the next slide. So this makes it all the more important to become a visible expert. As Chris showed, your services are valuable. You are going to be in demand if you aren't already. But the important thing is to make yourself more visible so that people will know more about your expertise, okay? So let's look at some of the top benefits of being a visible expert to you and your firm, okay? So, there are quite a few. Your brand as an individual will experience a lift, and but if we want to simplify, okay, you'll enhance your personal brand. You'll increase your ability to attract new business. You will also amplify your ability to raise your profile. So not only is your profile raised, but you're able to, once you've reached a certain level, raise it even further and more quickly in dramatic ways. So you're able to gain more credibility, which helps you, get the speaking opportunities and the opportunities to write articles or submit op-ed pieces to major newspapers, just as an example. This in turn will give you more professional flexibility, because if you choose to, you can open up your own practice and also choose your clients. So what we're learning here is that becoming a more visible expert really turns business development on its head. Now let's take a look at earning potential. What we're showing here is the premium that clients are willing to pay or expecting to pay when they're working with visible experts. We're showing here, the amount of the billing rates difference between visible experts and your average professionals. It shows that even when you're at level 1, your clients will likely expect to pay 194% to 240% above the average professional. And then take a look at, when you go all the way to level 5, it's close to 900%, all the way up to almost 1,400%. So what we're seeing here is that along with the visibility and the credibility comes higher recognition of the value that you deliver. And this is why, we consider today's visible expert the new generation of rainmakers, especially in our digital world. Visible experts are able to draw more attention online and command higher rates, enabling their firms to generate even more revenue. So let's take a look at the next slide, because now we look at, well, how do clients benefit from the visible experts that they work with? We often think about the benefits to the experts themselves, but there are distinct benefits to the clients. And the number one that more than half of the buyers cited was that they learned just from working with the experts. Now, clearly, clients don't hire visible experts just to learn from them. They hire them to solve problems. But experts are like teachers. They teach clients, how to approach a problem in new ways or more effective ways, and especially how to address a problem when it's continually changing, like a lot of the problems our clients face today. The bottom line is they help make complex problems easier to understand. When I think of this, I think of a quote that Einstein once said, which is, if you can't explain it simply, you just don't understand it well enough. So clearly, these experts provide clients the value of presenting information in ways that they can easily digest and therefore implement. So what comes with, more credibility, more credibility on the side of the client, more increased visibility, and more even attracting more business. The clients are actually experiencing this just as the visible expert is also experiencing the same. This is because working, with a visible expert has a kind of halo effect. Clients enjoy more positive impressions from their own clients just by working with you. So, in addition to helping your clients solve their problems, your halo effect is actually able to expand their brand, strengthen their brand, and also help them grow their business even quicker because of the brand recognition. This is a very powerful benefit, and it's not one that a lot of people think about, but that halo effect is very powerful. Okay, let's look at the next slide. So how do you make your expertise more visible? Because, marketplace visibility doesn't just happen by accident, and it's by no means easy. The first thing you want to do is to look at where your target audiences and your clients are looking for information to help them solve their problems, especially the ones that you can help them address. And then you want to align your techniques with the channels that they're using. So we're finding here that buyers are actually searching online almost as much as they're asking for recommendations from their trusted peers. We find that the biggest change is a 48% jump in the number of buyers who are listening to experts speak on the topics that matter the most to them. And these are, within the confines of a conference, sometimes through podcasts. As we know, over the past couple of years, podcast consumption has dramatically risen. So in addition to that, clients are also reading more articles and blog posts. They're clearly looking online for information that they need. We find an increase, a 9% growth in the consumption of research reports, ebooks, and how-to guides. So what this is telling us is that buyers are looking for proven solutions. They want surefire ways to solve their problems. And anything that is research-driven, that is based on the realities of industries, facts, that's going to attract their attention and build their engagement. What we don't see here are brochures or promotional materials. They're looking for educational and helpful content. So what do these preferred channels then imply about how to market yourself, right? So one, you need a robust website. You need a website where you can blog frequently, distribute very educational and helpful content. Two, you want a strong search engine optimization strategy, because anytime that your buyers are entering their searches using keywords, you want your website to appear on the first few pages, because after the first two, they'll probably stop looking, especially with the algorithmic updates that are being made by Google and all the other search engines. Third, you want to blog frequently, maybe once a week if you can, but definitely more than once a month. You also want to write guest articles or guest posts. You want to show that third parties see you as a credible authority by featuring your work, by entrusting their audience to you. Next, by the same token, you want to speak at conferences. You want to also have, guest appearances at these podcasts where you can share your industry insights. You also want to offer your expert opinions to the reporters and the bloggers who are covering your areas of expertise, your industry. So it's very important to build up your relationship, not just with your target audience, but also with the media and other influencers who represent your industry. So the last thing I'd like to say about, these techniques is to use about 6 at a time, because that's the right combination that visible experts use. They use actually an average of about 6.5. So take a look at this list and see how they align with your buyers and make full use of them. Okay, now we'll switch to the next slide. So how do you develop your own visible program, your visible expert program? Oftentimes you will need the help of someone who has already done this. At Hinge, we've been able to help a lot of different clients, but I'd like to bring your attention to Nishit Desai and Associates. Nishit Desai and Associates is a huge law firm in India and the Asian continent, actually. And they started out as a small law firm that focused on tax law. But as that business grew, the founder decided to use visible expertise as their main engine for further business growth. So they engaged our help with making 17 of their attorneys more visible, with an eye to establishing a micro monopoly for each of these attorneys. It was really meant to grow the practices through the micro monopoly of their niches. Well, at the end of the program, 87% of those attorneys were able to win new business. And today, I'm happy to say that Nishit Desai has won multiple awards for being the most innovative law firm, not just in India, but across Asia. And they continue to draw more of the Fortune 50 clients that type of companies that they've been serving. So one thing that we want to, if you are not in a position, for instance, to create or work on a multi-level visible expert program, you can always start by getting the training that you need. The good news is NACVA and Hinge through Hinge University, NACVA members are able to access the visible expert course and other related courses for just $10 on your first month. So remember those techniques that we discussed earlier where the buyers are looking? You can gain access to full courses that cover those different channels, how-to guides, such as how to implement search engine optimization successfully. How do you plan to have and to implement a high-performance website? All those how-tos, all those full courses are available to NACVA members at a deep discount. So $10 for your first 30 days. One thing that I'd like to add as a final note here is that I realize, and we know, because through our work with our clients, that there's always this deep concern that, well, what if my team becomes too visible? Then, they'll get poached or they'll leave the firm and form their own business. Well, the thing is, now that we have this talent shortage, visible expert programs are actually becoming talent magnets. Because if you think about it, especially with the mid-career professionals who are the most likely to leave and the hardest to find, they're the ones that are most interested in a visible expert program. So think about it. And on that note, I'm wrapping up.
Thank you, Rowena, for your time and for all the information. If any of you need more information about Rowena Figueroa, you have in front of you her email and additional social media. And with this mail, we pass our time, but it was amazing information. So thank you for joining us. And we will have our next show on November 14, 2022. So hopefully